one of the signal that usually help us understand gauge the current situation is the yield curve. So I wanted to ask you if you what's your thought? What's the situation about it? Are we seeing what do normal like people need to understand from the yield curve to actually understand what's going on in the economy? How they can use it as a signal of yeah where we are right now.
Yeah, sure. Like if you can go back to slides, like yeah, this one, like yeah. I'm gonna give you a short recap of what's the yield curve about. So basically, the yield curve is generally the plot of various yields for increasing maturities. So basically, the normal yield curve is generally upward sloping, meaning that long-term yields are generally higher than short-term ones. And yeah, basically the intuition behind this is that longer maturity entails greater risks for the investor, and therefore investor require a high risk premium, you know. And yeah, this risk premium is basically because if you buy a bond which has a longer maturity, well, you basically have a longer time frame to wait until you get your principal repaid, you know. So this higher time frame, this higher amount of time needs to be compensated with some risk premium for the risk of unexpected inflation or the risk of interest rate hikes that could happen in this time frame of 10, or like generally high maturity bond is intended to be like 10-year bonds. And well, so basically, yeah, the yield curve is generally upward sloping when we have a normal or a healthy state of the economy. But then, yeah, and we also see that like the short-term yields can be controlled by the Fed, especially by the demand for the bonds. Like if the Fed increases the demand of bonds by buying them, and like it is happening right now, then the prices of the bonds would increase, and since the yields are inversely related to the price of the bonds, so we have the price, then the principal and the coupons discounted by the yields, then an increase in the prices driven by this higher demand would then eventually mean that we have lower yields for short-term securities. So basically, what the Fed does is to increase the buy pressure by buying these bonds, and then consequently keep the 2 years or the short maturity bonds, pretty short maturity bond yields kind of low in order to keep this yield curve upward sloping. But then the fact is, well, I think like an insightful aspect of the yield curve is when the things are the other way around. So when we have short-term yields higher than long-term yields, so we have a downward sloping yield curve. So in this case, well, basically the intuition is that if the general view on the market is that a recession is near, then an investor will shift to the safest financial asset that the world economy can offer, which is the US bond, and it's like the 10-year bond. This is the safest financial asset that the economy can provide you. Well, basically, if there are many buyers for this long-term treasury in a relatively short period of time, then of course the price will increase and the yield of this bond would decrease, because the yield is mainly driven by the expectation. You know, like the federal funds rate remains constant, but then the yield is not like really related to the federal funds rate, but it's basically a sign of what are the expectations of the investors on the market. So basically, when we have an inversion of the yield curve, we have shorter maturity bonds with higher yields compared to longer maturity ones. And this is a clear sign of recession. Like this is a clear, like at least in the past, it kind of was successful in predicting recession, as we can see from the chart here in the early 2000s. The 2-year bonds, like the 2-year bonds yield basically overcome the 10-year ones, and subsequently with the recession. The same happened also in 2008. It happened also in 2020, and now we are already, like, we're still facing an intersection of the 2-year and 10-year treasury yields. So yeah, basically this predicts or give us the possible scenario of an upcoming recession in the following years. But yeah, this actually it's like a common metrics to look at by all the investors. But then my question to you is like, how genuine this predictor can be, given the manipulation that the Fed has on the market? Like, do you think like this signal is not saying much more about the economy than what the investor already know about it?
Yeah, that's a very interesting question. So yeah, as we see, like the way of printing money into economy right now is actually purchasing assets, and the main asset that the central treasury, the Federal Reserve buys is bonds. So the way they inject new money into the economy is actually buying new bonds with like just imaginary new printed money from the state, so that they actually keep the rates low, because yeah, by buying lots of bond, they go against the sell off. They actually keep the rates very very low, and so they can actually stimulate economy going forward. So I think yeah, we are entering now, and we've seen in the last decade a period of financial manipulation itself, in which we see in like all this bond market, like this signal is actually like degenerating like it was in the past, if the 10 treasury just been affected so much by this purchasing of bonds from the Federal Reserve. And it's not only from the Federal Reserve, they're actually putting like obligation from the banks to actually to buy bonds, or like pension fund to actually to buy bonds, even in this time of high inflation, with actually real return rates are negative, because you have a 2.5 return, but then if inflation is 7.9, it means that you're losing 5%. So yeah, the main idea, I think, like we can see an example of where we're going right now in Japan. So in Japan, like the main buyer of bonds is actually the central bank. The central bank owns like 80% of the main bond market, and you can see like this is very stable. Volatility is like around 3, while in the US market is at 11. So yeah, the main purchasing like they provide liquidity to the market, keeping the rate low. And yeah, as I said before, this is actually the way that they need to do this by to actually keep the economy going, especially in a period when the state is so over indebted, so they can keep the payment on the debt. So yeah, that's one of my consideration that I will do in the yield curve. And yeah, for the people that are following us, that are not very keen on economy, like they're probably asking, why are they talking about bonds? Like, he already did a very good explanation in why bonds are expectation from the market and what they mean for the economic growth. But then I think bonds are like at the basic of all the economic calculation. So bonds is basically a claim on the dollar with a risk-free rates on top of it. So these risk-free rates, so all these rates that we are talking about on this curve, is actually the base of all calculation of all valuation of the economy, of assets. So for example, if we see all these crashes and that we're seeing after this tightening cycle, is because the actual valuation of stocks is very intrinsically related to the actual rate of bonds, of this risk-free rate. So there's a model called the discounted cash flow model that in which the denominator is actually one of the main important one is the treasury yield. So yeah, I think in general that's my idea of the hill curve. And do you have any other consideration you want to add?
Yeah, I like to specify a bit, like yeah, the discounted cash flow model, and like it usually implies that the risk premium that we demand for the valuation of a company is strictly related to the risk-free rate plus a premium given the market risk. But yeah, apart from this, which is really interesting, uh, I think we're still missing a point about the yield curve. Like, do you think, like you mentioned Japan, and this, and Japan is kind of famous for its monetary policy of the yield curve control. And this is basically a stimulus approach in which the central bank aims at setting a specific long-term interest rate target, and they basically buy as many bonds as necessary to achieve this. And what do you think are the advantages of this policy compared to the usual quantitative easing that the Fed is known to use? You know?
Yeah. I think like what we see now is that the purchase of asset and the increase on the money supply as a consequence of it is being staggering, an amount like 40%, like probably like 4 or 5 trillions US dollar printed in less than 2 years that you would never thought in the past. But if we actually look in country they're already like more a little bit more forward in this new new way of managing policy, we see that the actual amount of treasury or purchasing or quantitative easing is actually way higher. Like to actually implement this yield curve control, so the next step would be like fixed yield to us. Like we've seen all this recent sell off, and to actually keep the situation under control will mean fix the rates of each single treasury, each single bond to a certain price. So 2.5% for a 10-year, 2% for 5 years, 1.5% to a 2 year. And to actually to be able to do that, as we said, there's a inverse relationship between price and yield. So if you want to keep yield low, it means you will have to buy as many bonds possible, and combat the sell-off of bond. So the amount of liquidity or quantitative easing that is required to do so is so much higher than the recent printing of money of like 40% of the supply of 5 trillion. And yeah, this that we're seeing is basically nothing. Like we can see, like for example, the Fed balance sheet is like 40% of GDP, while in Japan it's like 130% of GDP. So the amount of quantitative easing, so the new money injected, so there will probably consequent in more inflation, would be so much more in the future. And this is just the beginning. This is probably the last card that they can actually play in order to keep the situation under control. That we've seen this manipulation. This manipulation is sadly it could probably come to like even price control in the future. But this is more like speculation for myself. So I will just stop here. And yeah, did you have any other thought?
Yeah, like I think we can stop here, but then let's make a bit of summary about what we talked about. So, well, we basically gave you like some tools in order to assess how healthy an economy is, which is basically the inflation rate, the interest rate, um, the unemployment rate, and the yield curve. So basically, these are four key instruments in order to assess how an economy is doing, how healthy an economy is doing. And I think even for the like for the people who are approaching the world of finance from scratch, I think these are like these four tools are really powerful in order to have a clear idea of how the situation is going on, like how the economy is performing. You know, so I think in order to make educated investments or educated decisions, it's always really nice to have a clear idea of what's going on in the world. And also to read about the news daily, or to inform yourself about what is going on, for example, in Ukraine. What are the consequences of the on the global economy? Like this is always really highly suggested in order to make good and educated investments. You know. So this is my main takeaway about this session.
Yeah, yeah. I think that's very important. Yeah, one of the things like yeah, financial economic education is one. I think people should actually spend more time about it because one of the main things with our life that we handle is money. That like our life sadly depends on is money. So it would be very important for people to actually understand how money works, especially in a period right now where inflation is running hot and we're basically seeing this transfer of value from the people to the state. So if you need to protect your purchasing power, like you can't just hold cash, which is losing like officially 7, but it would be I think it's double-digit number of inflation, and so you need to protect your purchasing power. So people that hold asset, any type of asset, even we've seen the S&P 500 is been performing amazingly, like up 180% from the lows of 2020. But even like asset that actually that are made to preserve purchasing power, like gold or like Bitcoin. So you I think understanding what's going on is crucial because we just live in a world we like we just depend so much for money, and we yeah the world is just so much financialized. Just having a bit of financial education, just a tiny bit, to preserve your all the wealth that you work so hard to produce, so that you can provide for your children, you can have your retirement, all these important things in life.
Yeah.
So yeah, I think we can wrap it up here. Thank you so much for watching. Please subscribe and smash the like button. We're gonna do more of these episodes, so if you like it, just please just share it to all your friends. And yeah, see you next time. Have a good day.